ಫೈನಾನ್ಷಿಯಲ್ ಅಡ್ವೈಸರು. ಸೊ ಬಹಳ ಫೈನಾನ್ಷಿಯಲ್ ಇದರಲ್ಲಿ ಬಹಳ ಹೆಸರುವಾಸಿ ಮಾಡಿದ್ದಾರೆ. ಸೊ ಇವತ್ತು ಅವ್ರನ್ನ ಕೇಳ್ಕೊಂಡಿದ್ದೇನೆ, ಶೇರ್ಗೆ ಒಂದು ಕಣ್ಣು ಹಾಕಿದ್ರೆ ಹೇಗಿರುತ್ತೆ ಅಂತ, ಶೇರಿನ ಮೇಲೆ ಒಂದು ಮೇಲ್ನೋಟ ಅಂದ್ಬಿಟ್ಟು. ಸೊ ಅದಕ್ಕೋಸ್ಕರ ಇವತ್ತು ಅದ್ರ ಬಗ್ಗೆ ಮಾತಾಡ್ತಾರೆ. ಸೊ ಶೇರ್ ಮೇಲೆ ಗೊತ್ತಾಯ್ತಲ್ಲ, ಅಲ್ಲಿ ಇಲ್ಲಿ ಎಲ್ಲ ಇಂಗ್ಲಿಷ್ ವರ್ಡ್ಗಳು ಜಾಸ್ತಿ ಇರುತ್ತೆ. ಅವ್ರು ಕನ್ನಡದವರೇನೆ, ಕನ್ನಡದಲ್ಲೂ ಮಾತಾಡ್ತಾರೆ, ಇಂಗ್ಲಿಷಲ್ಲೂ ಮಾತಾಡ್ತಾರೆ. ದಯವಿಟ್ಟು ಬಾಲಾಜಿ ಅವರೇ, ನಿಮ್ಗೆ ಈಗ.
ಓಕೆ, ನಮಸ್ಕಾರ ಎಲ್ಲರಿಗೂ. ನಾನು ಫೈನಾನ್ಷಿಯಲ್ ಅಡ್ವೈಸರ್ ಆಗಿದ್ದೀನಿ, ವಡಾಲ್ ಅಂಡ್ ರೀಡ್. ಅಂಡ್ ಇನ್ನು ಕ್ವಶನ್ಸ್ ಏನಾದ್ರೂ ಇದ್ರೆ afterwards you can call me on this number. Okay, before I go to share market, I know all of us are interested in the CARES Act, and I wanted to stress what benefits we can immediately take based on CARES Act. I think government has passed nearly $2.3 trillion, which is nearly 3 times the funding they have done when 2008 market collapse was there. This is the biggest aid they are providing. So as part of the CARES Act, these are a few things which we may want to address immediately. Then I will go back on the investments and other stuff. So there is no
ಬಾಲಾಜಿ ಅವರು ಫುಲ್ ಸ್ಕ್ರೀನ್ ಮಾಡಕ್ಕಾಗತ್ತಾ? ಲೆಫ್ಟ್ ಅಲ್ಲಿ ಸ್ವಲ್ಪ ಉಳ್ಕೊಂಬಿಡಿ, ಸ್ವಲ್ಪ ಎಕ್ಸ್ಪ್ಲೇನ್ ಮಾಡಕ್ಕಾಗತ್ತಾ? ಕಾಣುತ್ತಾ ಎಲ್ರಿಗೂ? ಓಕೆನಾ? ಓಕೆ ಅಂದ್ರೆ ಓಕೆ, ನೋ ಪ್ರಾಬ್ಲಮ್.
Yeah, I think that. People who are 70 and a half last year, they are supposed to take RMD this year. If you have already taken these 3 months RMD, you can put it back into IRA. So there is no penalty, there is no taxes on RMD since you are putting it back in RMD. So that's one thing. The second option is government has provided anybody who is affected by COVID-19, either physically or financially, they can take $100,000 loan from their 401k plans or IRA together. In addition, they can also take $100,000 loan from their 401k if they want, but then they can pay it back over 3 years. So if you don't pay it back in 3 years, obviously under $100,000, there is taxes. But even if somebody is less than 59 and a half now, there is no penalty of 10% for that. Then next point is, I think all of us are likely to get $2,400 free money from as part of this package. But for that to qualify, family, husband and wife, their joint income AGI should be less than 150K. And if it is 150K up to 198K, it will drop 5% for each 5% for each $100 you will lose $5. Above 198K, you don't get anything. So check your line 7 on 2018 tax return. If that is more, and if you think in 2019 tax your income is less, I would suggest go and file your 2019 tax return now, so that your AGI is less than 150. But otherwise, by default, if you are not filed 2019 taxes, they will take 2018 tax return to calculate that number. And for singles, those numbers are 75K to 99K. And in addition, each child under 16 will get $500. And unemployment, they have extended to 39 weeks. And if any of our students have taken loan, the loan payment is suspended for 2020. It is not forgiven. Only thing is that loan period will extend by 1 more year. And I think all of us know by now, tax filing deadline is July 25th. Sorry, July 15th. I mistyped it, that's fine. Then business owners, the April 15th estimated tax, they can pay by July 15th. But June 15th estimated tax, they have to pay by June 15th. There's no concession on that. And there are a lot of loan options available for business owners, so less than 500 employees, through SBA, and SBA loans are typically provided through your local banks. So that's basically, I just wanted to cover the CARES Act, the highlights, and if you have more questions, we can talk about that. Now, let me go back to this one. Is it 100%? Can you see, Valish? Okay, this is typical stock market, which you have seen, but
yeah, we can see, sir.
Yeah,
we can see.
This is a typical S&P 500 return in last 40 years, since 1980 to 2020. And we have gone through, similar to COVID, we have gone through, not so drastic, but we have gone through AIDS, plague, SARS. At each time when this happens, the market has dropped, then it came back. Yeah. So if you can see, even measles, as recent as 2019, slightly dropped, came back. So this chart shows at each epidemic I know COVID is a pandemic. Each epidemic, how the market has dropped. So S&P 500 in this case, in 6 months it has dropped by -6%. But in 12 months, how it has performed? In the case of AIDS, in 12 months it was still negative. In case of the plague in September '94, S&P 500 actually grew by 8.2%, and in 12 months since the plague, it grew by 26%. So if you see all these things, the average price return on S&P has been 8.8% after 6 months, or 13.6% over 12 months. So if any of those things are, if you believe in history, if you are going to think it's going to repeat something, so I know temporarily we are all going through. Today I think S&P is 2488 or whatever, and I think from whatever I hear from the economists and pundits, it may still go down another 10%. Maybe the bottom could be 2250, but then they say by December 31st, it will be around 2900. So hopefully we will all get back there. And GDP wise also, I think first quarter will be -0.4%, and second quarter GDP is estimated to be -20 or 25%. But I think third quarter they are estimating it will come back by 10 or 15%. So, and the recovery, what I hear is a U-type recovery. It's not a steep recovery. Probably that means there is a slow recovery. Even 2021, it will be slow. Maybe we will see 2019 December figures probably in 2022 January. So that's what we need to be prepared for it. So this is one of the charts which I wanted to explain, that each time any of this epidemic or pandemic happened, so every time market dropped, but if you see the chart, always it is on a growth trajectory. So many times okay, the next chart, what I'm coming to, what I'm going to share is, see, many times when these things happen, human psychology, we all take a drastic decision to either liquidate or whatever. When you liquidate, or sometimes people get worried or they liquidate, that means you are physically taking a loss. So then you wait, so you don't know when to enter the market. So this chart shows each, again, last 40 years, since 1980 to 2020, each time. So say, for example, take say 2010, I'm just taking, S&P was 13% up, it ended at 13% up, but in the same year, it was -16% down. So like that, if you take last year market was 29% up, but it was also down by -7. And this year, year to date, the lowest it was down was -34%. But as of now, as of I think 3 days ago, it was -9%. So these variations may happen all along during 365 days in a year, but then it may end up at a higher number. If you see in past 40 years, you have 1, 2, 3, 4, 5, 6, 7, 8 times it was down. So most of the 80% of the time the market has been up, but then intraday negative returns, they are there everywhere. So the moral of the story is just stay put and focus on your long-term plan and go with that. So then the next chart. So next chart again shows, this is just to give an example. This is S&P 500 against 75-25 portfolio. When we say 75-25, if somebody is younger, they are aggressive, they have put 75% of their portfolio in stock investments and 25% in bond investments. How their portfolio has done. So that's what we are going to see here. So if you see again, same S&P 500, which you have seen before. So here again, as of now, you have seen -34% even this year, as of 4 days ago. Whereas a 75-25 portfolio, it is -23. Whereas S&P is -26. Because the reason why it has gone down less, because we have bonds in that. So bonds always work as a cushion, like a shock absorber in a car. So I know many times people may not like bonds or don't like whatever, but I always like them to have some bonds in their portfolio. So this is 75-25. Same thing if you take say 2010. if you take this one, the portfolio has done more or less same as S&P 500. Whereas on the down market, S&P went by -16. This portfolio has, in variation was -11. So this is one of the charts for 75-25. I have a similar chart for people who are moderate aggressive. So this is a 60-40 portfolio. In industry, most of the portfolios are compared with 60-40, which is very moderate. Again, here, if you see this year, say market is, as of now, it is -21, whereas this the 60-40 portfolio is -18. So you lose less by having a diversified portfolio. So similarly, if you again take 2010, again S&P 500 was 13, but since it's a moderate portfolio, this has given 12% return. So that's another way. The next chart is again similar one, but with 35-65. Somebody who is retired. So I would expect them to have more in bonds, like 65% and 35% stocks. So in this case, this person's investment, I know, don't compare everything with S&P, because S&P doesn't reflect exactly what is your risk tolerance and where you are in your lifestyle and in your age. So in this case, S&P has done 13%, but this portfolio has done 10%. But at the same time, intraday, S&P has lost 16% here, but this portfolio has lost only 4%. And again, this year, as of 4 days ago, though S&P has lost -34, this portfolio has lost only 10%. So the moral of the story is, irrespective of what happens, like COVID-19 or tomorrow something else may happen. So as long as you have a diversified portfolio and stick with your plan, I think you will come out all right. So this is again another chart showing. Sorry, this is again another chart showing. Again 20 years from 1980 to 2020, average investor has done average 1.9%. Because why? Because average investor like us, we get scared. We always sell when the market is down, and we always buy when the market is up. Whereas whereas the other investments, if you take, REITs have done 9.9%, gold has done 7.7%, and homes have done 3.4%, and inflation is 2.2%. And just now, S&P 500 is 5.6%, 60-40 portfolio 5.2%. If you take all the bonds have done 5 or 4.5. If you take that, the average investor has done 1.9. So the average investor always, when they get scared with all these things happen, well, like whatever COVID-19 is happening, they go and sell it. So they sell it at the bottom. Then they don't know when to buy. Nobody knows. We cannot be right on both times. I can be right when selling. I don't know when to buy back. So I may buy it at a higher level. So that's the reason we always lose out by doing those wrong decisions. But as long as you have a discipline based on your risk tolerance, if you pick one of these portfolios and stick with that, then I think you will come out all right, even with such a drastic situation that we are facing now. Again, here is another S&P 500. Again, that's the industry benchmark, if you are fully invested, again, last 40 years, average return is 4.46. Suppose if you miss 10 best days, it has come down to 0.72. If you missed out 20 best days in a year, you lose actually -1.67. Missed 60 best days, you are -82. So 7 of the 10 best occur within 2 weeks of the 10 worst days. So we do not know. On worst day we may sell, but we may not get back into market within 10 days. So we don't know. So many times the best days come within 2 weeks. So we do not know when. Right now I do not know when is the bottom. But I can think maybe another 10%. That's my guess, or from whatever I hear. But I do not know. But if I have a diversified portfolio based on my risk tolerance, I think I will come out all right based on this, because I'm not making any jerk reactions based on market condition. So that's few things which I wanted to share. Then I also wanted to share a sample portfolio here. So based on your risk tolerance, this is a sample client. Say the sample client has got we have a questionnaire. Based on that, we come out with a risk number. So you can build based on that risk number. You can build this client's risk number is 65. I can build a portfolio to match with the risk number. And if you click on that, that portfolio may have various investments. I think it's so you can match your risk and your portfolio. This portfolio is got a risk. So with a $250,000 investment, this client or the sample client, he is prepared to lose $37,000 or makes that month with a 95% probability in next 6 months. So why 95% probability? Because other 5% we have all these black swan events like COVID or financial meltdown or whatever. So this portfolio, again, you can build whatever things. Suppose if you take a stock like Amazon, it has a risk of 92. At the same time, if you take a whatever some cash, let's say cash, money market, it has got a risk of 1. So you can build a portfolio with various equities and other stuff to match with the client's risk tolerance and stick with that. Talk to your financial advisor and come out with a plan and stick with that plan. That's my advice. Then some of the solutions which we have in the current market condition is you can rebalance your portfolio now. Suppose you had a portfolio whatever 60-40. Now because of a lot of sell-off in stocks and bonds, so maybe your stock portfolio has come down. So you rebalance and bring it back to 60-40. Then this is a good time to tax loss harvesting. So if you have a non-retirement, of course, in a retirement account, it doesn't matter. In a non-retirement account, you can sell all your loss-making equities and take the loss. And when the market comes back, you make gain. You can harvest these losses, so you don't have to pay much capital gain tax or long-term gain capital gain tax. So think of doing the tax loss harvesting. Most of the time we do tax loss harvesting at the end of year around December. But now this is a good opportunity to do that. So do that. Tax loss harvesting, there is one simple rule. If you sell something now, you cannot buy the same or similar equity in next 31 days. So that I think we can. Then you can go back and buy the same equity which you love after 31 days. So that's another thing. This is a big thing. The number 3, Roth conversion. This is a very good opportunity for all of us to consider doing Roth conversion. Because suppose I have $100,000 IRA. Now, if I convert to a Roth IRA, that $100,000 I have to pay tax in the current year. Now that $100,000 has dropped to $70,000. Now I convert, that $70,000 only I pay tax. And obviously, whether in IRA or Roth IRA, that is going to grow either way. So it's a good time to convert Roth conversion if you think it is a good time. Then generate cash for withdrawal. I'm sure I always recommend my clients to have 6 to 7 months of cash in a savings account so that you don't have to dip into this investments in a down market. What happens? It's a big risk for a lot of retirees when they are taking income from their investments. When the market drops, we call it the sequence of return. So since you are taking money at a lower base, it will last less time. Instead of lasting for 20 years, it may last for 15 years. So always have some strategy where you don't have to dip into this cash when the market is down. So that's one. And of course,
1 second, Balaji, just to take a time check. Another 5 minutes is okay for you?
Yeah, I'm done actually.
Okay, all right.
Okay, I think mortgage rates were down 3 weeks ago. Now it came back again, but I hear it may go down again. So if there is an opportunity, try to refinance, and it's a good time to increase contribution to your retirement account, because the reason being, because now the market is down, so hopefully it will come back, so your investment will, and it's a good time to increase contribution to your retirement account, because the reason being, because now the market is down, so hopefully it will come back, so your investment will grow big. Consider using bond proxies like fixed annuities and build cash from income, and dollar cost averaging, like all of us know, like we are contributing systematically equal amount every month in a 401k plan. That's a very good vehicle, the dollar cost averaging. So you are buying the funds or equities at a uniform dollar. So these are few of the strategies which I can talk. And with that, I think I'm done, Valish Avare. And
ತುಂಬಾ ತುಂಬಾ ಥ್ಯಾಂಕ್ಸ್, ತುಂಬಾ ಥ್ಯಾಂಕ್ಸ್ ಬಾಲಾಜಿ ಅವರೇ.
here is